Liberia's 1.21 billion US dollar budget, ambition or illusion? Hello, Africa, and welcome to BAV Africa Now, the weekly digest. I'm Amie Kallon, and tonight we turn the spotlight on Liberia, a nation taking a bold fiscal leap with a 1.21 billion US dollar national budget. The government says it's a plan for transformation, but critics call it a gamble. Is this Liberia's moment of economic renaissance? Or just another promise on paper? Stay with us as the bold African voice digs deep, comparing Liberia's billion-dollar plan to other African economies and asking, what will it really take for Africa's budgets to deliver for its people? A bold budget for Liberia. In Monrovia, the country's capital, Augustine Kapehe Ngafuan, Minister of Finance and Development Planning, formally presented the fiscal year 2026 draft budget, totaling roughly 1.21 billion US dollar. The New Dawn Liberia. Minister Ngafuan described the budget as being designed to accelerate Liberia's development agenda. He also emphasized that even without a key US $200 million bonus from ArcelorMittal, the budget would still be around US $1 billion. Liberian investigator. Further, the minister pointed to strengthened revenue collection, disciplined expenditure management, and ongoing reforms as underpinning fiscal stability. There was no budget shortfall last year, and there will be no shortfall this year, he declared. The budget is structured with key priorities: infrastructure development, roads, connectivity, health and education revitalization, agriculture and rural development, food security, livelihoods, security sector strengthening, youth empowerment and job creation, skills development. These align with the government's so-called arrest agenda, aimed at improving livelihoods, boosting productivity, and driving inclusive growth. Minister Ngafuan further promised macroeconomic stability, maintaining exchange rate stability, controlling inflation, and fostering a business-friendly environment. Analyst Liberia. The budget has now been submitted to the legislature for scrutiny, with implementation set to begin 1 January 2026. Front page Africa. Critical reflections. Ambition meets realism. While the intent and ambition of this budget are clear, a closer look raises several critical questions. Revenue projections. This budget places heavy weight on domestic revenue mobilization. According to reporting, the domestic revenue target is high and includes a large component, US $200 million, tied to a sign-on bonus from ArcelorMittal. Critics, including the Speaker of the House of Representatives, Richard Nagbeh-Kuhn, have cautioned that the revenue forecasts may be unrealistic and warned of the risk of shortfalls. In other words, an ambitious revenue target is only credible if the government delivers on tax reforms, broadening the tax base, enforcing compliance, and avoiding overdependence on once-off windfalls. Expenditure discipline and budget execution. Minister Ngafuan asserts there was no shortfall last year and there will be none this year. But history in many African governments shows that even well-intended budgets can suffer from implementation drag, leakages, weak monitoring, and weak links to service delivery outcomes. Given that the budget places heavy emphasis on infrastructure, agriculture, youth, and other high-impact sectors, the real test will be execution. Will the funds allocated indeed translate into improved roads, better learning outcomes, increased agricultural productivity, and meaningful youth employment? Macroeconomic and external risk. Maintaining exchange rate stability and controlling inflation are necessary but challenging in regions exposed to global shocks, commodity prices, aid flows, climate events. Liberia is not immune. Further, the budget's reliance on domestic revenue and sign-on bonuses, rather than large external grants or borrowing, may limit flexibility if targets are missed or global conditions change. Africa-wide comparison. Where does Liberia stand? Let's widen the lens. Across Africa, national budgets in the US billions are common in larger economies, but for the smaller states, reaching a US $1 billion plus mark is significant. In fact, one commentary noted this budget breaks the $1 billion mark in Liberia's history. Comparative points. In neighboring West Africa, e.g. Liberia, Sierra Leone, Guinea, managing limited fiscal space effectively has been a recurrent challenge. Budgets tend to slump under weak revenue bases, narrow tax collection, high recurrent costs, and dependence on external financing. By announcing a budget of this size with emphasis on domestic revenue, Liberia signals a shift toward greater self-reliance. However, the shift mirrors a challenge across Africa. Revenue mobilization must increase significantly to meet development needs and debt sustainability concerns. Many African governments have introduced youth and job creation initiatives, infrastructure pushes, agriculture boosts, etc. What makes or breaks them is alignment of budget, policy, capacity, and institutional governance. Without strong PFM, public financial management systems, and transparency, budgets become blueprint rather than outcome. The ARREST agenda can be compared to other national development frameworks across Africa, e.g., Ghana's Ghana Beyond Aid Vision, Kenya's Bottom-Up Economic Transformation Agenda, Senegal's Plan Senegal Emergent, all lean on the mix of infrastructure, human capital, agriculture, youth, and private sector development. The lesson: ambition is necessary. Realism and institutional capacity are indispensable. Forward-looking: what to watch and why it matters. As we look ahead, here are the key markers and why they matter for Liberia and the region. 1. Revenue mobilization outcomes. Watch how the tax base expands, how non-tax revenues evolve, and whether the ArcelorMittal bonus is realized. If revenue falls short, the risk of budget shortfall will materialize, eroding fiscal credibility and investors' confidence. 2. Budget approval and legislative scrutiny. The budget has been submitted, and whether the legislature scrutinizes effectively and amends where necessary will affect transparency and public buy-in. A weak process may signal governance deficits. 3. Execution and service delivery impact. Beyond what is approved, execution on the ground will be the real test. Will roads, schools, agricultural programs deliver measurable improvements? Real earnings from jobs, rural incomes, health outcomes will determine whether citizens see tangible dividends. 4. Macroeconomic stability and external buffers. Will Liberia maintain exchange rate stability, control inflation, avoid unsustainable debt or external vulnerability? Since many African economies are vulnerable to external shocks, maintaining resilience is critical. 5. Regional spillovers and peer learning. Liberia's path may offer lessons to smaller African states that seek to scale up budgets and deviate from heavy external aid reliance. The broader region will watch whether this shift yields sustained growth, stronger institutions, and improved livelihoods. 6. Transparency, accountability, and citizen participation. The Finance Ministry encouraged citizen and stakeholder review of the budget once tabled. Meaningful participation and transparency can help anchor trust. African governments that engage civil society and ensure oversight often score better on governance and outcomes. Why this budget matters beyond Liberia. This is not just Liberia's fiscal exercise. It is emblematic of a broader African transition from budgets constrained by aid and external borrowing toward more ambitious, self-funded, and domestically driven development strategies. If Liberia succeeds, delivering infrastructure, services, and jobs, it could serve as a small state model of transformation. Conversely, if it fails, the blueprint will remind us that ambition without capacity and resources without rigorous execution will fall short. For the wider African development community, Liberia's fiscal year 2026 budget becomes a case study. Can a small, post-conflict economy break the billion-dollar threshold, mobilize revenue, exert fiscal discipline, and still deliver on growth, inclusion, and stability? As the new fiscal year approaches, eyes will turn to Monrovia, not only to see the numbers, but to measure the outcomes. Will the ARREST agenda move from promise into performance? Will citizens feel the change? And will Liberia's bold fiscal move resonate across Africa? Unpacking the fine print, cracks and caveats. Despite the strong narrative of ambition and reform, the latest draft budget reveals several structural caveats that require vigilance. For one, while the headline figure of US 1.211 billion is framed as a major shift toward investment-led growth, the plan still sees about three-quarters of that budget falling under recurrent spending, US 1929.6 million. With only US 281.5 million, a 154.8% jump year-on-year earmarked for the Public Sector Investment Plan, PSIP, allafrica.com. In practice, this means that while new infrastructure, schools, roads, and services are in the spotlight, much of the budget still goes to payroll, goods and services, and other standing commitments, a familiar pressure point in many African states. Furthermore, the fiscal plan depends heavily upon one-off or semi-irregular inflows, specifically the US $200 million signature bonus from ArcelorMittal being channeled entirely into the PSIP, Global News Network Liberia. While this is presented as good news, it also raises questions about sustainability. If that bonus is not repeated or if its terms change, what happens then? Another dimension, Liberia's debt service burden is set to spike. The budget projects debt service of US $230 million in 2026, a more than 50% increase year over year. That obligation competes directly with development priorities, meaning the government must tread a fine line between growth-oriented investment and fiscal sustainability. There are also voices of critique. Civil society and media analysis highlight the risk of elite capture. Allocations to the legislature and other high-visibility areas have increased sharply, while sectors such as agriculture remain much smaller in funding terms. This raises the question, will the benefits of the budget reach the most vulnerable Liberians, or will they disproportionately flow to political insiders? Finally, the execution risk remains high. Liberia's economy is still relatively small, GDP US 5 to 6 billion, and characterized by structural weaknesses, narrow tax base, large informal sector, dependency on extractives. Unless the reforms flagged, revenue mobilization, digital economy taxes, enforcement, take hold, the risk of shortfall, budget deviation, or non-delivery remains. Regional and continental perspective, lessons from peer countries. If we turn our gaze to the broader African stage, Liberia's budget warrants comparison not only in size, but in strategy and risk. Consider the narrative of shifting from aid borrowing dependence toward stronger domestic resource mobilization. Across Africa, this is a core ambition. For instance, countries like Ghana have emphasized Ghana beyond aid, while Kenya has adopted a bottom-up growth strategy. Liberia's target of domestic revenue providing 94% of all revenues, as reported, signals alignment with that trend. However, the story of many African states also shows that increasing the budget envelope without strengthening institutions often leads to implementation shortfalls. For example, countries that raised infrastructure allocations but failed to ensure accountability or pipeline readiness often ended up with ghost projects or minimal service delivery gains. A further point, small states like Liberia often face sharper trade-offs. With limited resource bases, the margin for error is thin. A 5 to 10% revenue shortfall or cost overrun can derail the entire year. Larger states may absorb such shocks with more cushion. Lastly, the ambition to link budget priorities, youth employment, agriculture, infrastructure to growth and inclusion is familiar. But again, the imperative is execution. Funds need to flow to counties, rural areas, communities, not just central ministries. The emphasis on citizen review and public participation, which Liberia has flagged, is a positive comparative signal. In sum, Liberia's plan is bold and mirrors best practice aspirations, but the structural risks are elevated by its size, context, and institutional capacity. Forward-looking signals. What happens if things go right? What if they don't? Looking ahead, the fiscal year 2026 budget sets up two diverging scenarios, one optimistic, one cautionary, both with implications not only for Liberia but for neighboring states and Africa at large. Scenario A: delivery, growth, and credibility. If revenue targets are met via GST increase, digital tax enforcement, improved compliance, and PSIP funds begin to deliver visible projects, roads, schools, energy infrastructure, then Liberia could witness a measurable uptick in growth, job creation, especially youth, and investor confidence. Success would enhance Liberia's fiscal credibility, potentially lowering borrowing costs, attracting private investment, and strengthening its voice in regional economic integration dialogues. For the region, a success story of a small state raising domestic revenues, delivering infrastructure, and moving from aid dependence toward investment-led growth would be a significant case study. Scenario B: shortfall, implementation lag, and credibility erosion. If the revenue base underperforms or the one-off bonus fails to materialize, spending cuts or reallocations may be necessary, delaying or canceling key projects, which erodes citizen trust and investor appetite. If recurrent expenditures crowd out investment, or if capital spending is executed inefficiently, cost overruns, corruption, weak procurement, the bold promise may turn hollow. The debt service burden would become a constraint rather than a manageable cost. For Liberia's neighbors, this would serve as a cautionary tale. Ambition without execution and large budgets without commensurate institutional strengthening may backfire. Key watch points in the near term. Q1 of 2026. How revenue performance begins, whether the LRA and MFDP deliver on the deep dive projections. MFDP, budget approval process, how the legislature amends or holds the government accountable. This process will signal governance maturity. Infrastructure project rollouts. Are contracts awarded? Are timelines met? Are there independent audits or civil society tracking? External shocks. How vulnerable is the budget to commodity price swings, global interest rate shifts, or climate disaster costs, especially in rural agriculture sectors? Regional spill-in. Will investors and development partners view this as credible? Will the budget translate into partnerships, private sector investment, or regional integration linkages, e.g., cross-border trade, ECOWAS corridors? The bigger picture: West Africa, fiscal transition, and citizen expectations. In many West African states, citizens are growing impatient with budgets that read well on paper but deliver less in reality. Thus, the social contract is under pressure. Governments promise growth, youth jobs, roads, and services. But if everyday realities, power cuts, bad roads, unemployment persist, trust erodes quickly. For Liberia, which carries a legacy of civil conflict and developmental fragility, the expectations may be higher and the margin for error thinner. The fact that the government is emphasizing accountability, public review, and transparency is notable. Yet these are not functions of the numbers alone. They need systems, independent audits, civil society oversight, open data dashboards, and local government capacity. From a regional governance lens, if Liberia executes well, it could strengthen its posture in regional institutions such as African Development Bank, International Monetary Fund programs, and within ECOWAS frameworks. If not, it may find itself backpedaling on fiscal space, borrowing more, or even in crisis mode. This is the point in our weekly digest where I ask you, our viewers and listeners, to reflect. Is a bigger number the milestone? Or is it the delivery and tangible improvement in people's lives? The answer in Liberia will matter not just for Monrovia, but for how Africa manages its transition to self-reliant, accountable, and inclusive growth. In our next segment, we'll highlight how Liberia's draft budget compares to the latest plans in Sierra Leone and Ghana, analyzing what they are doing similarly or differently and what best practices might emerge. The institutional test. Governance, participation, and transparency. One of the linchpins of the budget's promise is institutional capacity. The government of Liberia is anchoring fiscal year 2026 on a vision of citizen-centered investment, with allocations for health, education, infrastructure, and accountability. Yet the reform agenda is as important as the fiscal numbers. If the institutions supervising revenue collection, public procurement, audit, budgeting, and community oversight are weak, then even the best-funded programs may fail to deliver. For African states at large, this remains a recurring theme. Bigger budgets without stronger institutions tend to underperform. Liberia's budget flags increased funding for oversight agencies, for example, US $34.4 million for transparency and governance in FY 2026, as noted in the recent draft. So, the budget does more than allocate funds. It implicitly signals a governance challenge. Will Liberia's public finance architecture step up? The same question applies across Africa, especially in small economies where the track record of audit, procurement, transparency, and citizen participation has often been patchy. The regional ripple effect and peer reflection. When we step back and compare across Africa, several observations become salient. Smaller African economies such as Liberia are now submitting billion-dollar budgets, marks of ambition, and perhaps new scale. For Liberia, the jump to about 1.21 billion US dollar, 94% domestic revenue, is significant. Ministry of Info and Culture. Yet the constraints are sharper: narrower tax bases, weaker institutions, higher vulnerability to external shocks and donor shifts, for example, the withdrawal or reduction of external aid. The emphasis on youth empowerment, infrastructure, agriculture, and rural development is common across African states. But so too are the risks: overambitious revenue projections, heavy recurrent spending, weak execution, and elite capture. For instance, critics in Liberia already point out that the increase in legislative spending may reflect privileging of elites rather than public service investment. Hence, the case of Liberia becomes relevant for the region. If it succeeds, it will show how a small state can raise domestic resources, deepen accountability, deliver services, and reduce dependence on external aid. If it struggles, the broader lesson may be about the limits of budget size, absent capacity, governance, and political will. Forward path. What should citizens and leaders focus on? As we draw toward the wrap-up of tonight's story, let me offer advice, both to African citizens and to their leaders, so that the promise in budgets becomes reality. Advice to citizens: engage with the budget. Whenever a draft budget is tabled, as in Liberia, where the finance minister invited stakeholders to review it, citizens should ask, where is the money going? Are the sectors that matter to my community receiving meaningful allocations? Monitor execution. Budgets are plans, not outcomes. Track whether roads are built, health clinics upgraded, teachers paid, students fed. Demand open data, community audits, local participation. Hold leaders accountable. If budgets include lofty promises, youth jobs, agriculture, infrastructure, then hold leadership to those promises. If recurrent spending explodes or one-off bonuses dominate, ask tough questions. For instance, in Liberia, the boost from the US $200 million signature bonus from ArcelorMittal Liberia is substantial, but is it sustainable? Think long-term, not just short-term. Development is not just 1 year of spending. Encourage investments that build capacity, institutions, skills, and resilience. Be vigilant about equity. Ensure the poorest, the rural, the youth, women, and marginalized groups benefit, not just a narrow elite. The critique in Liberia of misallocation toward the legislature serves as a caution. Advice to leaders: be realistic in revenue and expenditure planning. Ambitious budgets are admirable, but only credible if the numbers are grounded in realistic assumptions, strong tax reform, and robust collection mechanisms. Over-optimism risks shortfalls. credibility loss, and cuts to critical services. Prioritize investment over consumption. As the Liberian budget shows, large recurrent spending can crowd out development investment. Leaders must channel resources toward growth sectors, infrastructure, agriculture, human capital, while containing non-productive spending. Strengthen institutions and accountability. A budget is more than a ledger, it is a governance tool. Build audit capacity, open budgeting, citizen participation platforms, transparent procurement, independent oversight. Otherwise, leaks and inefficiencies will erode impact. Ensure sustainability and flexibility. One-off windfalls, e.g. mining bonuses, are helpful, but relying on them is risky. Diversify revenue, build buffers, prepare for external shocks, commodity drops, aid cuts, climate events. Engage citizens in meaningful participation. Incorporate community voices in setting priorities, reviewing spending, monitoring outcomes. Public trust will only grow if citizens see their voices heard and their needs addressed. Regionally integrate and learn from peers. Look to other African states for best practices and lessons. For example, on youth employment, agriculture value chains, public infrastructure delivery. Cooperation with regional bodies, e.g., Economic Community of West African States, can unlock scale, shared learning, and investment. Summary of key messages. 1. Ambitious budget, significant scale. Liberia's fiscal year 2026 draft budget of $1.21 billion marks a major step for a small economy with dominant reliance on domestic revenue, 94%. Ministry of Info and Culture. 2. Strategic focus on growth sectors, infrastructure, health, education, agriculture, youth jobs, and security are clearly flagged as priorities under the government's arrest agenda. 3. Governance and sustainability are critical. Execution risk, institutional strength, realistic revenue projections, and equitable spending remain Achilles' heels, both for Liberia and across Africa. 4. Regional relevance. The budget presents a case study for small African states seeking to deepen self-reliance, but also underscores the structural vulnerabilities many share: narrow tax bases, external aid dependence, weak capacity. 5. Citizen and leadership roles. For budgets to deliver change, citizens must engage proactively. Leaders must match ambition with realism, institutional strength, and transparency. 6. Task for the future. The next months will reveal whether the budget moves from promise to performance, how Liberia executes, whether the public sees visible improvements, and whether this model can be emulated region-wide. Liberia's billion-dollar budget is more than numbers. It's a mirror reflecting the dreams, risks, and realities of Africa's economic transformation. Will it succeed? Time and the citizens will tell. Remember, Africa's progress depends not just on leaders who promise, but on people who demand accountability. I'm Amie Kallon, and this has been BAV Africa Now, Weekly Digest. Stay informed, stay bold, and never stop asking the hard questions. Subscribe, like, share, comment. Until next time, the bold African voice, where Africa speaks and the world listens.